When you tap your phone at a checkout counter, the transaction feels instantaneous. The screen lights up, pulsing outward, and the money seems to move before you even put the device back in your pocket. On a credit card network, approval is immediate, but cash moves on a slow truck. This T+1 system means funds arrive the next day. UPI operates differently. Here, money moves in real time. Approval and cash movement happen simultaneously, flying instantly from payer to payee. While UPI successfully solved the physical speed of moving money, that efficiency created a difficult economic reality for the companies building and maintaining the infrastructure. Most payment networks globally survive on the merchant discount rate, or MDR. This is the fee a store pays the network for every transaction processed. In India, the government has mandated that for UPI, this fee is strictly zero. The service is free for the consumer to use and free for the merchant to accept. There is no direct revenue generated by the transaction itself. Processing millions of instantaneous transactions requires significant server power and cybersecurity. This leads to the million-dollar question. If the revenue is zero and the operating costs are high, how do these companies survive? The answer is that the payments aren't the business. They are a tool used to build a different business model, often hidden from view. These companies use what is known as a wedge strategy. This involves offering a high-value service at a loss to gain a foothold in a competitive market. Zero-fee payments are a loss leader used to acquire millions of merchants. It is a more efficient way to build a massive user base than traditional marketing or sales teams. As this diagram shows, zero-fee payments act as the wedge. The actual profit comes from the stack built on top, higher-margin financial services that leverage this massive distribution network. To understand how these layers generate profit, we have to look at what happens during a high-value purchase. The focus has shifted. These platforms no longer prioritize making money from the movement of funds. They monetize the specific moment a customer decides to buy. Suppose a customer is at a digital checkout for a 50,000 rupee appliance. They decide they don't want to pay the full amount up front and select the EMI option for monthly installments. As they click that button, a digital handshake occurs behind the loading screen. The checkout interface fades to reveal a connection between the payment aggregator and an NBFC. An NBFC, or non-banking financial company, is the partner that actually provides the capital for the loan. The aggregator routes an instant underwriting request to the NBFC. The partner assesses the data, flashes green for approval, and sends the confirmation back. This arrangement splits the risk and the reward. The NBFC takes on the credit risk if the loan isn't repaid, while the payment aggregator earns a high-margin distribution fee for facilitating the deal. This B2B alliance is what allows the system to function. It transforms a simple, free payment interface into a high-margin lending ecosystem. The invisible digital handshake completes. The purchase is instantly unlocked, and the transaction is seamlessly finalized in mere seconds. The merchant wins because they close a sale that might have been abandoned without the option for instant credit. The consumer wins because they gain instant affordability without needing to go through a traditional multi-day credit application process. And the payment platform wins because it has found a way to generate significant revenue while keeping its core UPI service free. By coordinating in the background, these companies have created an alternative financial loop that operates entirely outside of legacy credit card networks. This isn't just happening for one appliance purchase. It is happening across the entire Indian economy. It redefines the checkout page. It is no longer just a digital receipt of a transaction that has already happened. Because of these alliances between tech platforms and financial institutions, the point of sale and the point of lending have been integrated into a single step. Modern Indian commerce is no longer just about moving money from one account to another. It is a system designed to scale consumer affordability at the exact moment a buyer is ready to commit.